to the Q2 and H1FY23 earnings conference call of Aditya Birla Sun Life Asset Management hosted by InCred Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jignesh Sial from InCred Equities. Thank you, and over to you, sir.
Yeah, hi everyone. Good evening, and on behalf of InCred Equities, I thank you all for the participation. We have along with us Mr. A. Balasubramanian, Managing Director and CEO of Aditya Birla Sun Life Asset Management. Over to you, sir, for the opening remarks, and you can go ahead. Thank you.
Thank you, Jignesh, and thank you for the introduction. I'm joined by our CFO, Mr. Parag Joglekar, and Prakash Bogle, who is investment in charge for IR relationship. Good evening to everyone for attending today's investors call. I hope you all had the opportunity to go through the earnings presentation, which is available on the stock exchange and our website. Let me first begin by wishing you all a happy Diwali and prosperous New Year. Let me also start the updates on the economy and mutual fund industry first, and I'll give a briefing about Aditya Birla AMC performance for the quarter ending 30 September 2022. Indian economy has been on a steady recovery path with an expected growth between 6.5% to 7% for FY 2023. This is mainly on account of the timely policy measures taken by the Government of India and the Reserve Bank of India. We have been managing to deliver this better performance compared to the global market, which is going through a lot of uncertainty. CPI inflation remains at elevated level, above RBI target of 4 plus 2% in terms of expectations. As a result of this, RBI may continue to remain hawkish for the near future in terms of policy rates. And policies given by the policymakers, in my own belief, will continue to remain strong and force India's growth to come back. The current uncertainty on the global market continues. Global economic activity is cooling off with a number of growth forecasts to downgrade. Inflation remains elevated despite improving supply chains, and central banks continue to front-load their tightening cycles by delivering outsized rate hikes. The most synchronized monetary tightening indicates will weigh on growth further. As I speak, many policymakers will come with more policy rate hikes. Developed economy rate hikes have made emerging market equities less preferable. FA has been a net seller, which is again known to all of us. But with increased retail and institutional participation, the Indian stock market has remained buoyant. Higher interest rates have brought back the investors' attention to the bond market on account of higher yields, that opportunities are being generated for investors to generate our fixed income product. The next 3 weeks will be filled with the long Indian festive seasons, where domestic spending will be higher. This will result in higher earnings expectations, with limited downside to earnings during the second half of FY 2023. In the equity market, our own belief will continue to remain strong, and buoyancy will continue on expectation of earnings recovery. With respect to the mutual fund industry, during the quarter, the quarterly average assets under management for the Indian mutual fund industry touched 39.04 lakh crore as on 30 September 2022, as against 37.72 lakh crore as on 30 June 2022, and grew by 8% to 36.19 lakh crore as of September 30, 2021. In Q2 FY23, the mutual fund industry witnessed some fall in inflows across various equity schemes on a quarter-on-quarter basis. A significant proportion of inflows came from flexi-cap fund, mid-cap and small-cap fund sectoral funds. At the same time, retail average assets management increased on account of higher AEM for both from T30 and B30 cities during period. As on 30 September 2022, the total number of mutual fund investors stood at 14 crores versus 11.32 crores on 30 September 2021, an increase of 25% on a year-on-year basis. Continuous awareness initiative being undertaken by the whole industry on SIPs. We have seen improved monthly SIP contribution The overall monthly SIP book was the highest ever, 4,976 crores in September 2022. The new SIP registrations have increased marginally as compared to last quarter. Total number of SIP now accounts about 5.84 crores accounts. The industry witnessed net equity sales of around 14,500 crores, excluding index funds in Q2FY23. However, there was a reduction in the net inflows as compared to the previous quarter, where the net inflows were around 59,000 crores. SEBI's relaxation on the NFO's embargo in Q2 has resulted in industry net NFO sales of around 2,800 crores, of which around 10,500 crores was in equity. The retail investors' concentration in the industry continued to remain in excess of 58%. At the same time, overall reduction in the fixed income assets is leading to a higher dominance of individual mix to the overall industry AUM. Coming to the ABSL AMC performance, ABSL AMC has been, of course, as a market leader and continued to remain so, working towards the financial inclusion, deepening of financial market, and developing the mutual fund industry as industry thought leader. We are well positioned due to our strong parentage and brand and multi-diverse distribution network and experienced investment and management team. In order to remain for building our future and ensuring best of our customers and shareholders, our area of focus has been delivering sustained investment performance and portfolio differentiation. This is something we keep emphasizing given the fact that strong investment performance will lead to incremental sales coming in the future. That remains one of our pillars and remains one of the high focus areas. Building retail franchise as we've done in the past, increasing the geographical footprint and strengthening the multi-channel distribution network. And third, growing our passive and alternate assets, having created a separate team of people. Building this size to the next level remains one of the key area of focus. And fourth is leveraging digital platform for customer acquisition by having our product on board on the basis of the performance as well as engagement that we have to create and create a customer experience in the digital platform. And finally, driving a strong, robust risk management practices, especially at a time where regulatory frameworks are becoming more and more tighter. Therefore, increasing the governance framework and risk management practices remains the sixth key area of focus for us in building our ANC to the next level. We at ABSL AMC are focused on growing our overall assets under management across different asset categories. And our total quarterly average AUM for the quarter ending 30 September 2022 stood at 2.94 lakh crore. Our total mutual fund quarterly average AUM was about 2.83 lakh crore with a market share of about 8.2% ex-ETF. Our equity AUM for the September 2022 quarter was about 1.19 lakh crore. Our equity mix at an all-time high of about 42.21% to the overall assets under management that we have today. As you stated, customer acquisitions remains an integral part of our strategy. While we have added significant folios in the last number of years to touch on 8.1 million folios. In fact, last quarter we added about 2 lakh folios in the Q2FY23. With that, we have overall folio count about 8.1 million folio count that we have. Our short-term equity performance, which of course went through its own challenges for a brief period, in fact has been now showing an improvement in the overall across all categories. As a result of that, we start seeing some inflows in our mid-cap fund and small-cap fund as well as the multi-cap fund. We have seen some of the positive inflows during the quarter driven by the improved performance and the push that is being given as some of the focus products as we have as the industry also has seen some inflows in this category. We are constantly working towards leveraging the bouquet of existing products while launching new products to build size and scale and increase the product per customers. We have been growing our retail franchise over the last few years with a special focus on increasing our footprint in B30 market. Therefore, we can improve the market share in the B30 market beyond what we currently have. Building SIP book size, we always have a great track record of having a higher market share in SIPs. That continues to remain a big focus area in order to build in sticky assets and create long-term value to the investors. We are also creating an awareness about multi-SIPs features that eases the process of investing in multiple schemes, as well as promoting harder kind of SIPs in order to grow our SIP book. As a result of these efforts, we have seen a significant improvement in the current quarter to our overall SIP book outstanding to about 931 crores, as against 867 crores as of September 2021. We also added about 2.6 lakh new SAP registration during the quarter. Currently, we have about 33 lakh SAP live account with us, which again the highest ever SAP account that we have today as an AMC. Last quarter, in order to increase our brand building as well as creating awareness about mutual fund industry and way of investing, constructing a portfolio, we launched the Pro Portfolio Investor Education Initiative, which focuses on the need to diversify investments across and within the asset class for wealth creation across market cycles. We believe mutual fund sahi hai, par ek kafi nahi hai. So that is the model in which we are building it in order to encourage more schemes to be bought within the equity portfolios in order to have a presence across the different market cap from the portfolio longer term wealth creation point of view. Our multi-channel market initiatives deepen our presence and market share has yielded positive results. Virtual relationship manager model, which we had instituted about 3 years back, has activated over 1,600 distributors. And through a Sampark, again another initiative that we have been undertaking for onboarding of new distributors, we empaneled 4,400 new distributors we added during the quarter. And customer loyalty and deeper engagement and service differentiation remains the cornerstone of our service to sales model, which once again we have created a separate 200 dedicated client personnel from the existing customer service team to take care of the service to sales requirement of the customers as a single point guiding and servicing investors' needs. This in fact has now started giving a little higher mind recall, which therefore should actually help in bringing in more participation for these customers as we move forward. With respect to the overall mix between retail and institutional customers, 50% of our asset contribution come from retail investors as of September 2022. In the same manner, the contribution from B30 cities also have grown to about 16.3. Our focus in building retail both in B30 and T30 market remain an integral part of our overall strategy. On the digital front, we continue to collaborate with the early stage startups to remain ahead of the curve, like what we did in the few years back in PhonePe, where we used to get reasonably good market share of about 35%, and enhance our process efficiency working with them closely to improve our market share coming from the segment. We onboarded 70% of new customers digitally, and currently 82% of overall transactions are done digitally, and 88% of the customers are now serviced via digital platform. We also empaneled 92% of our new MFDs digitally in the first half of FY23. Again, coming on the back of the emphasis that we are giving on how digital and technology capabilities that we are building in can help in building the business for our overall AMC. With respect to the building alternate business, our passive product offerings have gained momentum the last 2 quarters, which has grown by about 6 times compared to the last year to about 16,922 crores. Our existing passive bouquet has grown to over 28 products, and we have around 10 products in the pipeline. The customer base in this category has also grown to around 4,50,000 folios. On the PMS and AIF front, we have launched a suite of products like India Equity Service Fund and Asset Linked PMS, which is gaining some traction. In fact, the alternate investment fund that we have launched as a service-oriented fund, we have been doing a roadshow across the country, and hopefully this should help in having the first big success in the AIF product under the ABS AMC the last few years. Upon completion of the product, of course, we intend to launch a few more products in the AIF segment as part of our overall strategy to build the AIF as well as build our future profitability. On the offshore front, we have not seen a significant momentum. We have maintained, of course, in the overall assets under management. So we have been having some hopeful expectations that some of my existing clients will add to more contribution. That expectation has been there for quite some time, given the fact that investor experience has been good, but we still see some kind of incremental money coming in some of our existing customers in the offshore business. On the real estate front, I'm happy to share that we have completed the second close of Aditya Birla Real Estate Credit Opportunities Fund. In fact, upon completion of this, the next month or so, we will take this product to the overseas market with the Bental Green Work to raise money from overseas investors to invest in the real estate market. That also something we'll see some momentum coming in the current few quarters. We now move on to the financial for the quarter. Our focus continues to remain achieving robust asset mix between high margin equity and debt assets. I would also like to reiterate that the equity mix is an all-time high of 42.1%, for the last quarter. In Q2FY23, our total revenue, that is revenue from operation and other income, stood at 387 crores, up by 42% on a quarter-on-quarter basis. Our profit after tax stood at 191 crores, up by 86% on a quarter-on-quarter basis compared to last year. And for H1 FY 2023, our total revenue is at 661 crores as compared to 708 crores in the first half of FY 2022. The profit after tax in the first half of FY 2023 stood at 294 crores as compared to 328 crores in the first half of FY 2022. With this, I'll conclude my initial opening remarks. I'll open the floor for any question that you may have. I'll be joined by Parag, our CFO, and Prakash for taking any questions that may have to be answered by both of them. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Swarnabh Mukherjee from B&K Securities. Please go ahead.
Good afternoon, sir, and thank you for the opportunity. So I have three questions. First one on the yields. So I just wanted to know the slightly higher revenue yield for the quarter sequentially. So was this a function of you able to push some increase in yields on the debt side, or is this purely because of slightly higher mix of equity-oriented schemes? So that is the first question.
Yeah. We'll answer the question first, Rav. I'll ask Parag to answer this question. Yeah.
Good evening, Swarnabh. The yields are a little bit higher compared to the earlier quarters is mainly due to the mix of assets on the equity slightly gone up compared to earlier quarters. And debt, also the mix in between the various categories has slightly improved, resulting it is more of flattish yield on the debt side, not a great increase, but it is mainly on the equity which has seen slight improvement on the yields, overall mix.
Okay, so would we be in some near future if yields remain at this level, or on the fixed income side, or I mean the interest rates go up slightly, would we be able to push in any kind of expense ratio increase in that segment?
So we have been continuously focusing, as we mentioned earlier, also to strengthen the overall size of our AUM plus improve the equity mix in the overall AUM. Plus on the debt side, we are trying to build a long duration asset which will fetch us slightly higher yields on the debt side also. So that is the overall broad thought process which we have, and I think so it will help us to strengthen the yield over the longer duration.
Yeah, just to add to that, clearly on the fixed income phase, last 2 quarters, we have been, of course, trying to build some momentum on fixed income, though we have seen momentum coming in fixed income phase to a target maturity fund, which is akin to an FMP, which doesn't give you big margin, but definitely helps in building market share. At the same time, with the likely further hike in interest rates, and in all probability, once we get a visibility that now we are more or less close to the peak, we have kept 2 products ready to be pushed among retail and HNIs to build assets the way we used to have in the past, such as dynamic bond fund or medium-term plan. These are some of the products which are more mix of HNI retail-oriented products with the reasonably good expenses, which I can take into account interest of investors first. Then second, of course, good margins that we'll have both for ourselves for the distribution channels. That's something we have already kept the plan in ready. We launched the product because we used to see a momentum given the fact that currently the interest rate hike cycle continues.
Okay, sir, got it. That's very helpful. My second question is on the employee benefits expense side. So I see a slightly sequentially higher trend in the employee expense this quarter, and I also noticed that it is similar in second quarter last year. So is there a variable component here, or what is the underlying reason for this? And also, if you could let me know what would be the ESOP cost for this quarter.
Sonab, the cost for employees has increased in this quarter mainly due to the increments which has happened during the current quarter, which happens in the July month for us. So that is the main reason for increase in the cost on the employee side, and there was a couple of some one-time expenses on staff welfare, which we generally do in the second quarter of the year for the staff meetings. Compared to last year, it is more or less similar because or slightly lower, because last year we launched the ESOP plan, where in the first year generally you have a larger expenses, and structurally it keeps on dropping as the year passes. So that is a slight reduction in the expenses on that account. So that is a slight drop compared to the last September quarter to this September quarter.
Okay, sir. So should we then for the next 2 quarters take this 70 crores as a run rate for employee expense?
So this should be the flattish, but as we may be beefing up team on various alternate asset or any other strategy we may want to run, there may be slight increase if we beef up the team on those
products. Just to add to that, Saurav, while we've been quite conscious about keeping the employee cost under control, as Parag explained, there's a marginal increase again due to the increment that's being given, plus any new recruit comes a relatively higher cost. While that will be the case, of course, once the output start coming in as part of the productivity, which has been one of our big area of focus, therefore the cost will come under check. While that's our endeavor, of course, we also know how to now build the business to the next level. We may want, of course, beef up the talent pool further. If at all we do that, then it may probably see marginal increase in cost. At the same time, I'm only of the belief that as individual productivity starts getting better, that incremental cost may become a very small component of the overall incremental growth that we can expect.
Sure, sir. And the last question from my side, sir, regarding the alternate assets. So this has been, the AUM has been hovering around that 11 to 12,000 crore mark for the last few quarters. Wanted to know from your side how to think about this number over the next couple of years, and how can we think about also the yields coming from this segment? Thank you.
See, one, as a need for building alternate business, when we set up a separate vertical few quarters back, which is beginning of this year only we did that, and now they have put things in place, including the product. Second is new leadership team that we have beefed up to head our PMS, who has got about 20 years of experience. He came on board about the month of July. Since he came on board, we have launched our first AIF product, which we are hopeful of closing this product first. I think once it is done, we can have a series of launch in line with what we believe as a theme that we can offer to the HNI customers. That's something we do have a plan. Second, this is as far as the AIF is concerned. As for the real estate concern, after almost 10 years of break, after launching the first product, we never launched any product. Now we have seen the first success of the real estate product, where we intend to take it to the next level. And third, which we believe that interest rates having gone to where they are today, and we also believe that the corporate bond spreads will widen, therefore will provide an opportunity to launch a credit opportunity fund the AIF phase. That's also something we have now kept in place, a product wherein we have taken approval, and that will also be launched as part of the product offering of exercise. And lastly, with respect to the offshore, as I mentioned, has remained flat, close to about 10,000 crores size. We're not seeing an incremental contribution coming from though the business itself on its own, but it's not been highly productive from the business growth point of view, which we believe it's a function of interest rate differential, function of FII flows into the country, and function of leverage benefit that both investors will get invested in India. Once we see some change in that, I think we'll probably be able to push through some success as far as offshore business concerned, therefore bringing in some incremental profitability. And lastly, some of our existing customers in the offshore who have been adding to the profitability, we've been making a pitch given the fact that we have delivered one of the best performance the last 15 years for these customers. They are supposed to give incremental money, and hopefully we are able to get that without increasing additional cost that can add to the overall AUM growth as well as profitability. These are some of the expectations that we have kept, and putting things in place to ensure that at least we have a push that we are able to give for this asset class, given the fact it can keep the cost under control at the same time add to overall profitability.
Sure, sir. Very helpful. Just in terms of yields, would this be more profitable than our equity segment or at a similar level?
Alternate assets, the aim is to have higher profitability compared to the mutual fund. I think that is what would aim, except the only difference that comes in AIF is you pay upfront commission, which again over a period of time it gets recovered. That's the only difference that we are able to see between the mutual fund and the AIF. That's the way AIF is also being sold. But otherwise, our endeavor would be to have a higher contribution of margins coming from the AIF space.
Sure, sir. Got it. Thank you so much. That's all from my side.
Yeah, thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and one now. The next question is from the line of Prayesh Jain from Motilal Oswal Financial Services. Please go ahead.
Hello. Yeah. Good evening, everyone. So firstly, now a much broader level question, probably from an industry perspective more than particularly from the Aditya Birla AMC perspective. So we've seen the industry going through a period where the core profit, except other income, has been very muted or declining in the last few quarters. This quarter possibly we've seen some uptick coming in because the yields have improved for most of the AMCs. But from a medium-term perspective, say 2 to 3 year perspective, do you think that the industry can actually report a strong profit growth? Mainly given the fact that yields, whether yields will be under pressure going ahead or it will improve. Cost, I understand, most of them have a lot of scale benefits. But primarily from a yield perspective, do you think that the profitability of the AMCs can see some improvement going ahead?
Yeah, thanks very for this question. The way I see the next 3-4 years, one, as you rightly put it, the scale benefit will continue to be one of the major contributors to the profitability. It may not increase in margins, it may actually increase in absolute profit. That I think will remain. Second is in terms of profit contribution. Well, of course, equity in the equity side, there has been quite discipline being maintained in terms of what the payout ratio and so on and so forth. That's something we are now seeing the discipline coming in. To the extent we can probably see a marginal improvement on the margin, not a significant improvement that could be expected, given the fact they're all mostly streamlined in terms of payout ratio and so on and so forth. And third, which I see the last 3 years, especially in the fixed income, has been not a so great year, given the fact interest rates were low, high margin products in the fixed income were also very low, and we as a fund house have had a huge success in terms of increasing the contribution when the rates were high, yields were high, portfolio returns were high, in order to get higher participation from investors, as well as the margins coming in terms of incremental profit. Which in my own belief is the next 3 years, you will see some contribution coming in the fixed income product. While one can argue within the fixed income space, the target maturity fund, which is nothing but index fund, is also growing. Therefore, the margin could be under pressure. One can probably argue in that phase. At the same time, I believe that the segment will be largely suitable for institutional customers and very, very HNI customers. But medium to retail customers would largely participate in the open-ended debt funds, which will have a little higher margin, same time not so high expenses, so to speak. At the same time, give a satisfied experience that to the investors can get it. So that's the way I see this coming in from the mutual fund contribution to the overall assets under management profitability.
Thank you, sir. So just on the equity yields, do you think that we are kind of close to bottoming out in terms of yields, or there is still some headroom wherein we will continue to see equity yields falling by another, say, 2 or 3 bips every year for the next few years?
I don't think so. Let me just open Parag also. Yeah.
So, Prayesh, as you know that it is the size increase in size, the TER goes down. So there will be some impact of that calculation. But as the size goes up, the absolute amount will increase on the equity contribution on the fee side. There may be slightly drop on the overall BIPS basis because the size will grow up and the TER may drop. May have some impact, maybe another couple of years on the yields as a BIPS to AUM.
But that's a good problem to have actually. In the sense,
absolutely.
That's a good problem to have. Even a margin drop comes because of the fact that size is growing. It increases absolute profitability. Any logical pressure coming in on the margins as generally is being perceived. See, more than the margin pressure on the existing schemes, the shift of assets from active to the passive, if it happens, then you will see that margin coming in. But my own belief is, at least for next 3-4 years, active will continue to have a dominant presence, and ETF will of course have a faster growth. Therefore, the convergence should happen maybe in the next 3-4 years in terms of margin drop, because of the ETF has grown, not because of the active funds margins have come down.
Okay. Now, another element of this has been the transition of or the transfer of legacy assets to the new assets. Where possibly, at what level would the industry be at? Possibly closer to 75-80% would have been converted from legacy to new assets, or we're still at around that 50-60% mark? I'm talking about the industry.
Yeah, very difficult to comment on that, but as it is almost a 3 years time period has gone up from upfront to trail model. I think so. Over maybe another couple of years, it should be replaced, because generally industry sees around 3 to 4 years of retention aging. That should be the case.
I think expectation that we should build around 3 to 5 year kind of holding period.
Okay.
In fact, since the time we moved to the trial model, in general, the holding period only has gone up. Normally, the churn happens either for moving from, even today, one may take credit that NFOs are adding more assets. I think we must note that 50% of the money into the NFOs come from either switch or moving from one fund to the other fund. That's the only assumption that they have to make, which is basically the number as well. I think in terms of holding period, I think since the SIP is becoming a large component of the assets, you'll probably see the holding period getting tilted more in favor of longer term, because the SIP book contribution overall assets and management is now keeps rising.
Interesting. Thank you so much, and all the best.
Yeah.
Thank you. The next question is from the line of Lalit Deo from Equirus Securities. Please go ahead.
Yeah, good afternoon, sir. So just 2 questions. Firstly, on the distribution side, so in the distribution mix, we are saying that there's a decline in the AUM which is coming from the banking channel. So could you share some light over there, and also could you talk about the incremental, the market share in the incremental flows which we are getting from the banking channel?
No, banking channel contributions largely one on account of withdrawal of fixed income space, where we saw some withdrawals in the STP or the corporate bond fund category. So that's something resulted in marginal dip in terms of absolute number has not fallen, but there is a drop in the market share as a result of this. Second is we also seen an improvement of contribution coming from the ND channels. Especially in SIPs, we have seen improvement of contribution coming from the ND channel, the lead ND channels that we have in the country, and we have seen some improvement contribution coming on the SIP side. Therefore, their contribution to the overall asset management has gone up. And third is because of the outflow on the fixed income space, even the institutional side. Therefore, that contribution also gets a little higher because of the some outflow that has happened on the fixed income space. It's a combination of these two things. The absolute number, if you have to take, there has not been any kind of significant drop on the absolute number.
Sure, sir. And so one data keeping question, could you tell us about the SIP AUM size as of September 22?
Yeah. Total number 40? 53.
It's 51,000 crores.
Sure, sir. Thank you, sir. That's all from me, sir.
Yeah. Thank you.
The next question is from the line of Dipanjan Ghosh from
Hi, am I audible?
Yeah, you are audible, Dipanjan.
Hello.
You are audible.
Yeah. Just two questions from my side. First, you highlighted on your SIP contribution increasing from the ND channel. If you can also break up your incremental SIP flows across channels, that will be helpful. Second, if I look at your SIP new registration market share, that seems to be on the lower side. So just wanted to get some sense of is it some particular channel where your SIP registration market share is on the lower side? And lastly, one data keeping question, if you can mention the number of employees that you had as of September 30th.
Yeah. As far as the SIP's contribution concerned, one, of course, the dominant share is coming from IFAs, second dominant coming from ND channels, and third, we are part of the drive with some of the banking channel SIPs, such as large banks like HDFC Bank and few others. Our SIP contribution has been there's been the contribution coming from these three channels. And fourth, of course, there's a marginal dip in the digital channel in terms of incremental contribution. I think if you look at the SIP registration, for your second question, SIP registration in general for the industry has dropped about 5.98 lakhs. That has dropped about 6.22 lakhs for the SIP registration as a whole for the industry. It's about 60 lakh SIP registration, which used to be in the range of close to about 7.55 million last year. In general, we have seen a dip in the SIP registration, but however, for us, the SIP registration normally we count per month is about 1 lakh SIP registration. We normally count 1 to 1.2. This quarter was about marginally lower, in line with the overall drop in the SIPs, but something while the SIP registration was relatively lower compared to the previous quarter, but we have increased absolute amount to about 930 crores. That again has come on the basis of the special focus that we have brought in order to add more SIPs with the high value ticket items, which could come in the form of 3 to 5 years kind of registration that they can do to the STP combination, as well as pushing through the target for absolute number is also equally important while you are focusing on SIP registration. That's something I've seen some kind of success. In fact, we keep pushing the team for retail across the country in order to increase the monthly contribution from 930 to higher number. The peak number that we used to have about 980. So one question, of course, often comes is SIP market share is dropping. I must mention the current SIP run rate that we have was built on the back of having 14% market share for almost a considerable period of about 4 to 5 years till 2019. And given the fact that increased participation coming from more and more players and everybody now is focusing only on SAP. That's something has dropped to some bit of market share confidence registration. But otherwise, our focus has been on building what we call absolute SAP contribution on a month-on-month basis. With respect to the channel, the digital channel I just mentioned, digital channel is purely on the base of whatever the algorithm they build. It can keep moving from one fund to the other fund. Even a smaller fund will get based algorithm. So we have roughly about 7.5% kind of market share in the digital channels, with about 78 channels that we track, anywhere between 6 to 7%. But as this starts, we taking some efforts to make sure some of the products are coming as part of the recommendation list. I think that's something can gain momentum as well. But broadly, if we have to see, the focus on building SAP is back on track. That's why you see the number coming in reflecting on the 930 crores contribution as against 898 crores of last quarter.
Sure. And on the number of employees?
1,351. Dipanjan is 1,351.
Okay. And if I can just squeeze in one more question. You mentioned on the yields trajectory over the next 2 to 3 years, but can you quantify the difference between your current yields on fresh flows on the equity side versus your existing blended yields on the equity business?
So Dipanjan,
repeating the question.
No, so I got it.
Yeah.
So Dipanjan, our yields, as we mention always, that generally the sharing with our distributor is in the similar range of around 60 to 65% of our DTR, and the company makes in the range of around 30 to 35% of the overall DTR. So that remains for us on the new flows.
Got it. Thanks. Thanks and all the best.
Yeah. Thank you, Dipanjan.
Take the next question. I remind all the participants, anyone who wishes to ask a question, press star and 1 now. The next question is from the line of Ravin Kurwa from ICICI Securities. Please.
Hello, am I audible?
Yes, Ravin.
Yeah, hi. So, sir, I just wanted to get back to the question where you mentioned that there are 2 products in the fixed income category which are ready to be launched. So, have they been launched in this Q3 or they are just ready to be launched?
No, we already initiated. We already rolled out the presentation of Dynamic Bond Fund with the renewed strategy that we used to have in the past. And medium-term plan, which again one of the largest fund for us, using a mix of good credit and high-quality papers. There also something we are now repositioning the product. We were not doing it earlier in the past, given the fact that we had a few assets which were yet to be rectified in the portfolio from a recovery fund, which got done in the last quarter. With that, now we are seeing an opportunity that fund also can be renewed from the point of view of promotion to the retail and medium HNI investors. Dynamic Bond Fund, we already launched it. We had multiple round of calls, and given as I mentioned earlier, given the current interest rate volatility, we will of course give a push once we believe that now time to build a size in this. And we have chosen these 2 products for 2 reasons. One, the portfolio yields are now getting better, so that expectations for investors can be met. Those who come into these funds as an alternate to bank fixed deposit. Second is as per other allocations compared to equity versus fixed income. And third is we used to have great success, significant contribution coming from these 2 segments of product offering in the past. That's something we believe that a similar success story can be created for the future. Therefore, the 2 funds we are positioning on that.
And sir, can you guide on the yields in these 2 products?
In terms of current expenses versus expectations?
Yeah.
Yeah. No, credit opportunity is fine. Currently about 1.1, right? Expenses.
Yeah. So depends. Sorry, Arvind, I don't have the number handy. I can. It's there on our website on the TER side, but it is in more than around 1%, 1.25 odd types.
Okay, that's really helpful. Thank you. Yeah.
There is a follow-up question from the line of Dipanjan Ghosh from Citigroup.
Hi, just one data keeping question. If you can quantify your ESOP expense for the quarter and how do you see that trajectory for FY24 and 25?
It is more similar. It's in the range of around 8 odd crore.
For the quarter.
For the quarter.
Okay, and any guidance for FY24?
So as I mentioned earlier, that it is generally a 40, 30, 20, 10 sort of dropping this thing. So over the period, it should drop. So this is currently the second year, first half. So it may continue in the similar range for the next couple of quarters, and then it will drop further.
Got it. Thanks.
Mr. Ghosh, any further questions?
No, thank you.
As that was the last question for today that the management could answer, I would now like to hand the conference over to Mr. A. Balasubramanian, Managing Director and Chief Executive Officer for closing comments.
Yeah. Thank you very much, ladies and gentlemen, for tuning in. And with this, we conclude our Q2 and our first half FY23 earnings call. Do feel free to reach out to us, to Prakash Bogle, who is our IR in charge for any queries that you may have. Thank you and have a nice weekend.
Thank you. On behalf of InCred Equities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.